Hello and welcome to Top 10 Most Googled Tax Questions in the US Answered. I'm your guide on this journey to demystify one of the most common sources of stress and confusion for millions of Americans: taxes. If you've ever found yourself staring at a tax form with a sense of dread, or frantically typing questions into a search engine as the tax deadline looms, you are not alone. The US tax code is notoriously complex, and it's constantly changing. It's no wonder that so many of us have questions. Think about it. From the moment you earn your first dollar, you're interacting with the tax system. It's a fundamental part of our financial lives, yet it's something that's rarely taught in school. We're often left to figure it out on our own, which can be an intimidating and overwhelming process. But here's the good news. It doesn't have to be that way. With the right information, you can approach tax season with confidence and clarity. That's exactly what this series is all about. We've compiled the top 10 most Googled tax questions in the United States, and over the next several chapters, we're going to answer them in a clear, concise, and easy-to-understand way. No jargon, no complicated legal speak. Just straightforward answers to the questions you're asking the most. Our goal is to empower you with knowledge. Whether you're a recent graduate filing for the first time, a seasoned professional trying to navigate new tax laws, a small business owner, or a retiree, this series will provide valuable insights to help you make informed financial decisions. We want you to feel in control of your finances, and a big part of that is understanding your tax obligations and opportunities. Important disclaimer: your financial well-being matters. Before we dive into the fascinating world of taxes, it's incredibly important that we start with a crucial disclaimer. The information provided in this series is for educational and informational purposes only. It is not intended to be a substitute for professional financial, tax, or legal advice. We are not financial advisors, certified public accountants, or tax attorneys. The content we will be discussing is based on our research of publicly available information from the IRS and other reputable sources. However, every individual's financial situation is unique. Your personal circumstances, your location, and a variety of other factors can significantly impact your tax liability. Therefore, we strongly urge you to consult with a qualified and licensed professional before making any financial decisions based on the information you hear in this series. A certified public accountant (CPA), a tax attorney, or a qualified financial advisor can provide you with personalized advice that is tailored to your specific needs and goals. They can review your individual situation and help you navigate the complexities of the tax code to ensure you are in compliance with all applicable laws and regulations. Think of this series as a starting point, a way to become more informed and to prepare you for a more productive conversation with a qualified expert. Our aim is to provide you with a solid foundation of knowledge, but we cannot and do not provide professional advice. Your financial well-being is of the utmost importance, and seeking guidance from a licensed professional is the best way to protect and enhance it. What's coming up in this series? So, what are these burning questions that have everyone turning to their search engines? Here's a sneak peek at the top 10 most Googled tax questions that we'll be tackling in this series. When is the tax deadline? A seemingly simple question, but one with crucial implications. How can I file my taxes for free? We'll explore the various options available for free tax filing. Where is my tax refund? The age-old question that keeps millions on the edge of their seats. What are the current tax brackets? Understanding how your income is taxed is fundamental. How much is the child tax credit? A vital credit for families across the country. What is the standard deduction versus itemizing? We'll break down this key decision for every taxpayer. How do I file taxes if I'm self-employed? A deep dive into the unique tax situation of freelancers and entrepreneurs. What are the tax implications of cryptocurrency? A modern question for a new age of investing. Can I deduct my student loan interest? A question on the minds of millions with student debt. What happens if I don't file my taxes? We'll discuss the consequences and what steps to take. We'll dedicate a full chapter to each of these questions, providing in-depth explanations, practical examples, and helpful resources. We'll also have some bonus chapters to cover even more of your tax-related queries. Our goal is to make this series your go-to resource for clear and accessible tax information. Looking ahead to Chapter 2. And that brings us to the end of our introduction. We're so glad to have you with us on this journey to conquer tax confusion. In our very next chapter, we'll be tackling the first and perhaps most time-sensitive question on our list. When is the tax deadline? We'll not only give you the key dates to remember, but also discuss what happens if you need an extension, and why it's so important to be aware of these deadlines. It's a foundational topic that you won't want to miss. Thank you for tuning in to this first chapter of Top 10 Most Googled Tax Questions in the US, Answered. We're excited to embark on this educational journey with you. Be sure to join us for Chapter 2, where we get right into the nitty-gritty of tax deadlines. Until then, take care, and remember that knowledge is the first step toward financial empowerment. Welcome back to Top 10 Most Googled Tax Questions in the US, Answered. In our last chapter, we set the stage for our journey into the world of taxes. Now it's time to dive into our very first, and arguably one of the most critical, questions. When is the tax deadline? It's a date that's circled on calendars in homes and offices across the country. For some, it's a finish line for meticulous planning. For others, it's a frantic scramble to gather documents and fill out forms. Regardless of where you fall on that spectrum, knowing the tax deadline is non-negotiable. Missing it can lead to unnecessary stress and financial penalties, and nobody wants that. So let's clear up any confusion and get you the definitive answer. The primary tax deadline in the United States for filing your federal individual income tax return is typically April 15th. If April 15th falls on a weekend or a holiday, the deadline is shifted to the next business day. For example, if April 15th is a Saturday, and the following Monday is a holiday like Emancipation Day in Washington, D.C., the deadline could be pushed to Tuesday, April 18th. This is a common occurrence, so it's always a good idea to double-check the exact date each year. This April deadline applies to most individuals filing Form 1040. It's the date by which you must have your tax return postmarked if you're filing by mail, or electronically submitted if you're filing online. But this date isn't just about filing your paperwork, it's also the deadline for paying any taxes you owe. This is a very important distinction that we'll talk more about later in this chapter. Important disclaimer, a friendly reminder. Before we go any further, let's pause for our essential reminder. The information provided in this audio series is for educational and informational purposes only and should not be considered professional financial, tax, or legal advice. We are not licensed financial professionals, and this content is not a substitute for the personalized guidance you can receive from a qualified expert. Tax laws are complex and subject to change, and your individual circumstances can greatly affect how they apply to you. We strongly encourage you to consult with a certified public accountant, CPA, a tax attorney, or another qualified professional for advice tailored to your specific situation. What if you live in a different state? Now, while the April 15th deadline is the big one for your federal taxes, it's also crucial to remember your state tax obligations. Most states that have an income tax also have their own filing deadlines, and they often align with the federal deadline. However, this isn't always the case. Some states may have different dates. For instance, a state might have a later deadline due to a local holiday. Therefore, it's always a best practice to check with your specific state's Department of Revenue or taxation agency to confirm their filing and payment deadlines. A quick search online for your state tax deadline will usually give you the most accurate and up-to-date information. Don't let your state tax deadline be an afterthought. Missing it can also result in penalties and interest. Needing more time? The magic of a tax extension. Life happens. Sometimes, despite your best intentions, you just can't get all your paperwork together in time. Maybe you're waiting for a corrected tax document, or perhaps a personal emergency has taken up all your time and attention. The good news is the IRS understands this. If you find yourself in a situation where you need more time to file your taxes, you can request an extension. Filing for an extension is a straightforward process. You can do so by submitting Form 4868, Application for Automatic Extension of Time to File U.S. Individual Income Tax Return. This form can be filed electronically using tax software, or you can mail a paper copy to the IRS. Filing for an extension will automatically grant you an additional 6 months to file your tax return, pushing your deadline to October 15th. Now, here is the most critical part about filing for an extension, and it's a point of major confusion for many people. An extension to file is not an extension to pay. This is so important that I'm going to repeat it. An extension gives you more time to submit your completed tax return, but it does not give you more time to pay the taxes you owe. If you anticipate that you will owe taxes, you are still required to estimate the amount you owe and pay it by the original April deadline. You can make this payment when you file your extension form. If you fail to pay by the April deadline, you will likely be subject to penalties and interest on the unpaid amount, even if you have a valid extension to file. So, how do you estimate what you owe? You can use your previous year's tax return as a guide, or use the information you have available to make a reasonable estimate. It's better to overestimate and get a refund later than to underestimate and face penalties. What happens if you miss the deadline? So, what are the consequences if you miss the tax deadline entirely, without filing for an extension? The answer depends on your situation. If you are due a refund from the IRS, there is generally no penalty for filing late. However, you do have a time limit to claim that refund. You typically have 3 years from the original due date of the return to file and claim your refund. If you wait longer than 3 years, you may forfeit that money to the U.S. Treasury. That's your hard-earned money, so you definitely don't want to leave it on the table. On the other hand, if you owe taxes and you fail to file and pay on time, the IRS can impose penalties and interest. There are 2 main penalties you could face. Failure to file penalty. This penalty is charged for not filing your tax return by the due date. It is typically 5% of the unpaid taxes for each month or part of a month that your return is late, up to a maximum of 25% of your unpaid taxes. Failure to pay penalty. This penalty is for not paying the taxes you owe by the due date. It is generally 0.5% of your unpaid taxes for each month or part of a month that the taxes remain unpaid, also capped at 25% of your unpaid taxes. As you can see, the failure to file penalty is significantly higher than the failure to pay penalty. That's why, even if you can't afford to pay your taxes right away, it is always in your best interest to file your return on time or file for an extension. By doing so, you can avoid the hefty failure to file penalty. The IRS also charges interest on underpayments, and this interest can also be applied to unpaid penalties. If you find yourself in a situation where you owe taxes and can't afford to pay, don't panic and avoid the situation. The IRS has options available, such as setting up a payment plan or an offer in compromise. The most important thing is to communicate with the IRS and be proactive. Key takeaways for this chapter. Let's quickly recap what we've learned in this chapter. The main federal tax deadline is usually April 15th, but it's always a good idea to confirm the exact date each year. Don't forget to check your state's deadline as well. If you need more time to file, you can get an automatic 6-month extension, but you still need to pay an estimate of what you owe by the original deadline. And finally, if you owe taxes, always file on time, even if you can't pay, to avoid the significant failure to file penalty. And that wraps up our discussion on tax deadlines. Hopefully, you now have a much clearer understanding of this crucial aspect of the tax process. In our next chapter, we'll be addressing another very popular question. How can I file my taxes for free? With the rising cost of tax preparation services, this is a topic that is more relevant than ever. We'll explore the various free filing options available to you, so you can keep more of your hard-earned money in your pocket. Thank you for joining me for this chapter. I'll see you in the next one. Welcome back to Top 10 Most Googled Tax Questions in the US Answered. In our last chapter, we navigated the crucial topic of tax deadlines. Now that you're armed with that essential knowledge, let's tackle a question that directly impacts your wallet. How can I file my taxes for free? Every year, millions of Americans pay for tax preparation services or software. And while those can be valuable tools, what many people don't realize is that they may be eligible to file their federal and even state taxes for absolutely no cost. The process of filing taxes can feel like a financial burden in itself, so finding a way to do it for free is a significant win. It means you get to keep more of your money, which is always the goal. So if you've ever wondered if there's a catch to these free services, or if you're simply not sure where to start, you've come to the right place. In this chapter, we're going to explore the legitimate, safe, and IRS-approved ways you can file your taxes without spending a dime. We'll break down the different programs, who is eligible, and what you need to know to take advantage of them. Let's unlock the secrets to a free and successful tax filing season. Important disclaimer: your financial well-being is priority one. As always, before we get into the details, we must begin with our very important disclaimer. The information presented here is for educational and informational purposes only. It is not, and should not be considered, professional financial, tax, or legal advice. We are not licensed financial advisors or tax professionals. The tax landscape is complex and your personal financial situation is unique. Therefore, it is essential that you consult with a qualified professional, such as a certified public accountant, CPA, or a tax attorney, for advice that is specifically tailored to your circumstances. This guide is designed to make you aware of the options available, not to recommend one over the other for your specific situation. The gold standard, IRS Free File. Let's start with the most official and widely available option, the IRS Free File Program. This is a public-private partnership between the IRS and several tax preparation software companies. Through this program, Eligible taxpayers can use commercial tax software from trusted brands to prepare and file their federal tax returns for free. Here's how it generally works. The IRS sets an adjusted gross income, or AGI, threshold each year. If your AGI is below that threshold, you are eligible to use one of the guided tax software options offered by the partner companies. This AGI limit is quite generous and is designed to cover a majority of American taxpayers. For example, for the 2024 tax year, the AGI threshold was $79,000 for individuals and families. This number can change from year to year, so you should always check the IRS website for the most current information for the tax year you are filing. The guided software is incredibly user-friendly. It functions like an interview, asking you simple questions about your income, family, and expenses. You provide the answers, and the software does the heavy lifting of filling out the correct forms and doing the calculations for you. It's designed to be straightforward, even for someone who has never filed taxes before. A huge benefit of using an IRS free file partner is that many of them also offer free state tax return preparation and filing. This is a fantastic bonus, as it allows you to take care of both your federal and state obligations in one place, at no cost. To access these offers, it's very important that you go through the official IRS website, irs.gov. Do not go directly to the company's commercial website. The free offers are often only available through the dedicated IRS free file portal. What if your income is above the AGI threshold? The IRS free file program still has an option for you. It's called Free File Fiable Forms. These are electronic versions of the paper IRS forms. There is no income limit to use these forms. However, this option provides only basic guidance and limited calculations. You need to know which forms you need to file, and you'll be doing most of the work yourself. This option is generally best for people who are comfortable with the tax filing process and don't need extensive guidance. In-person assistance, VITA and TCE programs. What if you prefer face-to-face assistance? The IRS also sponsors 2 fantastic volunteer programs that offer free tax help to those who qualify. These are the Volunteer Income Tax Assistance, VITA, and Tax Counseling for the Elderly TCE programs. VITA sites are generally located in community centers, libraries, schools, and other convenient locations. They offer free basic tax return preparation to people who generally make $64,000 or less, persons with disabilities, and limited English-speaking taxpayers. VITA volunteers are IRS certified and are trained to help with a wide range of tax situations, including identifying all the credits and deductions you're entitled to. The TCE program provides free tax help for all taxpayers, particularly those who are 60 years of age and older. TCE volunteers specialize in questions about pensions and retirement-related issues unique to seniors. While the program is focused on seniors, you do not have to be a senior to get help from a TCE site. Both VITA and TCE sites are a wonderful resource if you want the peace of mind that comes from having a trained individual review your tax situation with you. To find a VITA or TCE site near you, you can use the search tool on the IRS website. Commercial-free editions. What to watch out for? Beyond the official IRS free file program, you've likely seen commercials from major tax software companies advertising their own free versions. These are often called simple return editions. These can be a good option for some filers, but it's important to understand their limitations. These free commercial versions are typically designed for very simple tax situations. For example, they might be suitable if your only income is from a W-2 from an employer, and you plan to take the standard deduction. If your tax situation is more complex, for instance if you have freelance income, investment income, or want to itemize deductions, you will likely be required to upgrade to a paid version of the software. This is often referred to as upselling. The key is to read the fine print. Before you start entering your information, make sure the free version supports all the forms and schedules you need. If you start with a free version and find out halfway through that you need to upgrade, it can be a frustrating experience. While these products are a legitimate option for those with simple returns, just be a savvy consumer and know what you're getting from the start. Your path to free filing. So let's recap your free filing options. Your first stop should be the IRS free file program at irs.gov. Check the current AGI limit to see if you qualify for the guided software. If you do, it's one of the best and most comprehensive free options available. If your income is higher, you can use the free file fiable forms. If you'd prefer in-person help, look for a local VITA or TCE site. And finally, if you have a very simple return, a commercial-free edition might work for you. Just be mindful of its limitations. Filing your taxes doesn't have to be expensive. By taking advantage of these free resources, you can fulfill your civic duty and keep your tax preparation costs at zero. That brings us to the close of this chapter. In our next session, we'll be tackling a question that's on everyone's mind after they've filed. Where is my tax refund? We'll explore how to track your refund, what can cause delays, and what to expect after you've hit that submit button. Thank you for joining me, and I'll see you in the next chapter. Hello and welcome back to Top 10 Most Googled Tax Questions in the US, Answered. You've done the hard work. You've gathered your documents, you've navigated the forms, and you've successfully filed your tax return. Now comes the part that everyone eagerly anticipates: the arrival of your tax refund. For many, a tax refund is the largest single sum of money they will receive all year, and it's often earmarked for important goals, like paying down debt, building up savings, or covering a major expense. So, it's completely understandable that once you've hit that submit button, you're going to ask the million-dollar question: where is my tax refund? The waiting period can be filled with a mix of excitement and anxiety. You might find yourself checking your bank account multiple times a day, or rushing to the mailbox with a sense of anticipation. In this chapter, we're going to demystify the refund process. We'll show you the official, secure way to track your refund directly with the IRS. We'll also talk about the typical timeline for receiving your money, and explore some of the common reasons why your refund might be taking longer than expected. Our goal is to replace that feeling of uncertainty with clarity and peace of mind. Important disclaimer: your guide to information, not advice. As we dive into the specifics of tax refunds, it's time for our essential reminder. The information provided in this audio series is intended strictly for educational and informational purposes. It is not a substitute for professional financial, tax, or legal advice from a qualified expert who knows your specific situation. We are not licensed tax professionals or financial advisors. Tax laws and IRS procedures can be intricate and may change. For personalized advice, please consult with a certified public accountant, CPA, an enrolled agent, or a tax attorney who can provide guidance based on your individual circumstances. Your best friend in the refund hunt. The Where's My Refund tool. Let's get right to it. The fastest, easiest, and most accurate way to check the status of your federal tax refund is by using the official IRS tool called Where's My Refund? You can access this tool in two ways. Online on the IRS website. Simply go to irs.gov and click on Where's My Refund? Through the IRS 2Go mobile app. The IRS has a free mobile app for both iOS and Android devices that provides access to the refund tracker. To use the tool, you will need 3 specific pieces of information from your tax return. Make sure you have your return handy, and enter the information exactly as it appears on the form: your Social Security number, SSN, or Individual Taxpayer Identification Number, ITIN. Your filing status. This would be single, married filing jointly, married filing separately, head of household, or qualifying widow, earth. The exact whole dollar amount of the refund you are expecting. Do not include cents. When can you start checking? If you filed your return electronically, you can typically start checking the status within 24 hours after the IRS has received your return. If you filed a paper return by mail, you'll need to wait longer, usually about 4 weeks, before your information will be available in the system. The IRS updates the tool once every 24 hours, usually overnight, so there's no need to check it multiple times a day. Understanding the refund status tracker. The Where's My Refund tool will guide you through 3 distinct stages of the refund process. Seeing your status move from one stage to the next is a great sign that everything is progressing as it should. Return received. This is the first confirmation you'll get. It means the IRS has your tax return and is beginning to process it. It doesn't mean your refund is approved, just that it's in the system. Refund approved. This is the milestone you're looking for. Once your status updates to refund approved, it means the IRS has finished processing your return and has approved the refund amount. At this stage, the tool will often provide you with a personalized date for when you can expect to receive your money. Refund sent. This is the final stage. It means the IRS has sent your refund to your bank for direct deposit, or has mailed a paper check to the address on your tax return. How long does it take? Typical refund timelines. The IRS states that it issues most refunds in less than 21 calendar days for taxpayers who file electronically and choose to receive their refund via direct deposit. This is by far the fastest and most secure way to get your money. If you filed a paper return, you can expect a significantly longer wait. It can take 6 weeks or more to receive your refund after mailing in a paper return. This is due to the time it takes for the return to travel through the mail, and for the manual processing required by the IRS. It's important to remember that these are just general timelines. You should not rely on receiving your refund by a specific date, especially when making large financial plans. Several factors can affect the timing. Why might your refund be delayed? What happens if it's been more than 21 days and your status hasn't updated? While it can be stressful, a delay doesn't automatically mean there's a serious problem. Here are some of the most common reasons for a refund delay. Errors on your tax return. Simple mistakes like a math error, a misspelled name, or an incorrect social security number can cause processing delays. Incomplete information. If you forgot to sign your return or left out a necessary form or schedule, the IRS will need to contact you for more information. Identity theft or fraud. If the IRS suspects that your identity has been compromised, they will hold your refund while they investigate to ensure it goes to the right person. Claiming certain credits. Returns that claim the Earned Income Tax Credit, EITC, or the Additional Child Tax Credit, ACTC, are, by law, held until mid-February to give the IRS more time to detect and prevent fraud. Your return needs further review. Sometimes, a return is simply flagged for a more detailed, manual review. This can be random or triggered by something on your return that needs verification. Refund offsets. If you owe other debts such as past due federal taxes, state taxes, child support, or federal student loans, the U.S. Treasury may use all or part of your refund to pay off that debt. This is called a refund offset. If this happens, you will receive a notice in the mail explaining the offset. If your refund is delayed, the "Where's my refund?" tool should provide you with a message explaining the situation or giving you further instructions. In some cases, the IRS may send you a letter in the mail requesting more information. It's crucial to respond to any IRS notices promptly. When should you call the IRS? The IRS strongly encourages taxpayers to use the "Where's my refund?" tool as the primary method for checking their refund status. However, there are specific situations where a phone call might be necessary. You should only call the IRS if it has been 21 days or more since you e-filed your return. It has been 6 weeks or more since you mailed your paper return. The "Where's my refund?" tool specifically tells you to contact the IRS. When you call, be prepared for potentially long wait times and have a copy of your tax return with you. That concludes our deep dive into the journey of your tax refund. We hope this chapter has given you the tools and knowledge to track your money with confidence. In our next chapter, we're going to get into the numbers. We'll be answering the question, what are the current tax brackets? Understanding how tax brackets work is fundamental to understanding your overall tax picture. Thank you for listening, and I look forward to having you with us for the next chapter. Hello and welcome back to our series, Top 10 Most Googled Tax Questions in the US Answered. So far, we've covered deadlines, free filing, and tracking your refund. Now we're going to dive into the very heart of how your income tax is calculated. We're tackling the fundamental question. What are the current tax brackets? The term tax bracket is one you hear all the time, but it's also one of the most widely misunderstood concepts in personal finance. Many people incorrectly believe that if they move into a higher tax bracket, all of their income will suddenly be taxed at that higher rate. This is a myth, and it can lead to a lot of unnecessary fear and confusion about earning more money. In this chapter, we are going to debunk that myth once and for all. We'll explain exactly what tax brackets are, how the U.S. progressive tax system works, and why understanding this concept is so empowering. By the end of our discussion, you'll have a clear and accurate picture of how your income is actually taxed, which is a crucial piece of knowledge for any taxpayer. Important disclaimer: educational information only. Before we break down the numbers, we must reiterate our standard, crucial disclaimer. The information provided in this chapter is for educational and informational purposes only. It is not intended to serve as professional financial, tax, or legal advice. We are not licensed tax professionals. The tax brackets and rules we discuss are subject to change, and their application depends entirely on your unique personal circumstances. For advice tailored to your financial situation, we strongly urge you to consult with a qualified professional, such as a certified public accountant, CPA, or a tax attorney. The progressive tax system, a staircase, not a switch. The United States uses a progressive tax system for federal income tax.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
The best way to visualize this is to think of it as a staircase, not a light switch. When you earn more money, you don't flip a switch that suddenly taxes all your income at a higher rate. Instead, you climb a staircase, where each step represents a different tax rate. Your income is divided into different segments, or brackets, and each segment is taxed at a progressively higher rate. This means that everyone, regardless of their total income, pays the exact same rate on their first dollars of taxable income. As of the 2024 tax year, the return you file in 2025, there are 7 federal income tax brackets: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. These percentages are your marginal tax rates. Your marginal tax rate is the rate you pay on your last dollar of taxable income. It's the rate that applies to the highest bracket your income falls into. It's important to note that the income thresholds for these brackets are adjusted almost every year by the IRS to account for inflation. Also, the income ranges for the brackets are different depending on your filing status. How tax brackets actually work. A practical example. This is where the concept really clicks for most people. Let's walk through a simplified example. We'll use the 2024 tax brackets for a single filer. Please remember, these are just illustrative numbers. For the 2024 tax year, the brackets for a single filer are 10% on taxable income from $0 to $11,600, 12% on taxable income from $11,601 to $47,150, 22% on taxable income from $47,151 to $100,525, and so on up to 37%. Now let's imagine a single filer named Alex has a taxable income of $50,000 for the year. This puts Alex in the 22% marginal tax bracket. But does that mean Alex pays 22% on the entire $50,000? Absolutely not. Here's how Alex's tax is actually calculated. The first $11,600 of income is taxed at 10%. Tax, $1,160. The next portion of income, from $11,601 up to $47,150, is taxed at 12%. That's a total of $35,550 in this bracket. Tax, $35,550 asterisk 0.12 equals $4,266. The final portion of income, from $47,151 up to $50,000, is taxed at 22%. That's a total of $2,850 in this bracket. Tax, $2,850 asterisk 0.22 equals $627. To find Alex's total tax liability, we add up the tax from each bracket. $1,160 from the 10% bracket, plus $4,266 from the 12% bracket, plus $627 from the 22% bracket, equals $6,053. As you can see, only a small portion of Alex's income was taxed at the highest 22% rate. The progressive system ensures you only pay the higher rates on the portions of your income that fall into those higher brackets. Filing status matters. As we mentioned, your filing status has a major impact on the income ranges for each tax bracket. The 5 filing statuses are: single, for unmarried individuals; married, filing jointly, for married couples who choose to file one return together. The income thresholds for the brackets are typically double those for single filers. Married, filing separately, for married couples who choose to file separate returns. The bracket thresholds are usually the same as for single filers. Head of household, for unmarried individuals who pay more than half the costs of keeping up a home for a qualifying person. This status has more favorable tax brackets than the single status. Qualifying widow, or for a surviving spouse with a dependent child, for 2 years after the spouse's death. You can find the specific income bracket charts for each filing status on the IRS website each year. Marginal rate versus effective rate. So we've established that Alex's marginal tax rate is 22%. But what percentage of their total income did they actually pay in taxes? This is called the effective tax rate. To calculate it, we take the total tax, $6,053, and divide it by the total taxable income, $50,000. $6,053/$50,000 equals 0.121, or 12.1%. Alex's effective tax rate of 12.1% gives a much more accurate picture of their overall tax burden than their 22% marginal rate. Your effective tax rate will almost always be lower than your marginal tax rate because of the way the progressive bracket system works. Understanding tax brackets is a game changer. It removes the fear of earning more and empowers you to make smarter financial decisions, whether you're considering a side hustle, negotiating a raise, or planning for the future. That brings us to the end of our chapter on tax brackets. I hope this explanation has made this core tax concept much clearer for you. In our next chapter, we will focus on a topic that is incredibly important for millions of American families. How much can I claim for the child tax credit? We'll explore what this credit is, who qualifies, and how it can significantly impact your tax bill. Thank you for tuning in, and I look forward to guiding you through our next topic. Hello and a warm welcome back to Top 10 Most Googled Tax Questions in the US Answered. In our last chapter, we demystified the complex world of tax brackets. Today, we turn our attention to a topic that is a cornerstone of financial planning for millions of American families: the child tax credit. For parents and guardians, raising children is one of life's most rewarding experiences, but it also comes with significant financial responsibilities. The child tax credit is a non-refundable tax credit designed to help ease some of that financial burden. It can make a real difference, potentially lowering your tax bill on a dollar-for-dollar basis. However, the rules surrounding this credit have seen some notable changes in recent years, which has led to a lot of questions. In this chapter, we will provide a clear and straightforward overview of the child tax credit based on the most current and stable rules. We'll walk you through what it is, who qualifies, and how it works so you can have a better understanding of how it might apply to your family's situation. Important disclaimer: for your information only. As we proceed, it is crucial that we begin with our standard disclaimer. The information provided in this audio series is for educational and informational purposes only and should not be taken as professional financial, tax, or legal advice. We are not licensed financial advisors or tax professionals. Tax laws, especially those concerning credits, can be complex and are subject to change. Your eligibility for any credit depends on your specific personal circumstances. For advice tailored to your situation, we strongly recommend that you consult with a qualified professional, such as a certified public accountant, CPA, or a tax attorney. What exactly is the child tax credit? At its core, the child tax credit is a tax credit that eligible taxpayers can claim for their qualifying dependent children. It's important to understand the power of a credit. Unlike a deduction, which lowers your taxable income, a credit directly reduces the amount of tax you owe. For example, if you owe $3,000 in taxes and you qualify for a $2,000 tax credit, your tax bill is reduced to just $1,000. This makes tax credits particularly valuable. Under the current tax law, the child tax credit is worth up to $2,000 per qualifying child. It's also important to know that a portion of this credit may be refundable through something called the Additional Child Tax Credit, ACTC. A refundable credit is even more powerful because if the credit is larger than the amount of tax you owe, the IRS will send you the difference as a refund. For 2024, up to $1,600 of the credit is refundable, and this amount is scheduled to increase with inflation in the coming years. The 4 key tests for a qualifying child. So, who qualifies as a qualifying child for the purposes of this credit? To be eligible, your child must meet 4 specific tests. The age test. The child must have been under the age of 17 at the end of the tax year. So, for the 2024 tax year, the child must not have turned 17 before January 1st, 2025. The relationship test. The child must be your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, or a descendant of any of these individuals, such as a grandchild, niece, or nephew. An adopted child is always treated as your own child. The residency test. The child must have lived with you for more than half of the year. There are some exceptions to this rule for things like temporary absences for school, vacation, or medical care. The support test. The child must not have provided more than half of their own financial support during the year. In addition to these tests, the child must be a U.S. citizen, a U.S. national, or a U.S. resident alien, and you must claim the child as a dependent on your tax return. You will also need to provide a valid Social Security number, SSN, for each child you claim. Income limitations, a major factor. Like many tax credits, the child tax credit is subject to income limitations. This means that if your income is above a certain level, the amount of the credit you can receive will be reduced, and may eventually be eliminated altogether. The income phase-out begins for taxpayers with a modified adjusted gross income, MAGI, of $400,000 for those who are married filing jointly, $200,000 for all other filing statuses, single, head of household, etc. If your income is above these thresholds, your $2,000 credit per child is reduced by $50 for each $1,000, or fraction thereof, that your MAGI exceeds the limit. This can make the calculation a bit complex, but most tax software will handle this automatically for you. It's important to be aware of these income levels because they can impact your tax planning. A note on recent changes. It's worth briefly mentioning that for the 2021 tax year, the child tax credit was temporarily expanded under the American Rescue Plan. The credit amount was increased, it was made fully refundable, and the age limit was raised to 17. Many families also received a portion of the credit as advance monthly payments. However, that expansion was for 1 year only. The rules have since reverted to the previous structure that we have been discussing in this chapter. The $2,000 credit per child under 17, with income limits of $400,000, $200,000. It's important to use the rules for the specific tax year you are filing for. Claiming the credit. To claim the child tax credit, you will need to complete and attach Schedule 8812, Credits for Qualifying Children and Other Dependents, to your Form 1040. If you use tax preparation software, it will typically identify your eligibility and fill out this form for you based on the answers you provide about your dependents. The child tax credit is a significant benefit for families. Understanding the eligibility rules is the first step to making sure you are receiving all the credits you are entitled to. That concludes our overview of the child tax credit. In our next chapter, we will explore another key tax concept. What is the standard deduction versus itemizing? This is a decision that every taxpayer has to make, and will help you understand the difference. Thank you for listening, and I look forward to having you join me for the next chapter. Hello and welcome back to Top 10 Most Googled Tax Questions in the US, Answered. In our last couple of chapters, we've unraveled tax brackets and credits. Today, we're tackling one of the most fundamental choices every single taxpayer faces when they sit down to file their return. It's the big decision. Should I take the standard deduction or should I itemize my deductions? This choice can have a significant impact on your final tax bill. For the vast majority of Americans, the answer is simple. But for millions of others, taking a closer look can unlock substantial savings. The terms standard deduction and itemizing might sound like technical tax jargon, but the concept behind them is actually quite straightforward. It's all about choosing the path that gives you the largest possible deduction, which in turn lowers your taxable income. In this chapter, we are going to break down exactly what both of these options mean. We'll explore what the standard deduction is, what kinds of expenses you can itemize, and how to figure out which choice makes the most sense for your financial situation. Our goal is to empower you with the knowledge to make this key decision with confidence. Important disclaimer: educational content only. Before we dive into the comparison, we must present our essential disclaimer. The information in this chapter is for educational and informational purposes only, and is not a substitute for professional financial, tax, or legal advice. We are not licensed tax professionals. Tax laws are complex, and the best choice for you depends entirely on your specific circumstances. We strongly encourage you to consult with a qualified professional, like a certified public accountant (CPA), who can provide guidance tailored to your individual needs. The standard deduction, the simple path. Let's start with the most common choice, the standard deduction. Think of the standard deduction as a no questions asked, fixed dollar amount that you can subtract from your adjusted gross income (AGI) to arrive at your taxable income. The IRS provides this option to simplify the tax filing process for most people. You don't have to keep detailed records of specific expenses or fill out extra forms. You just take the amount that corresponds to your filing status. The standard deduction amounts are adjusted each year for inflation. For the 2024 tax year, the return you file in early 2025, the standard deduction amounts are: single, $14,600. Married filing separately, $14,600. Married filing jointly or qualifying widow, or $29,200. Head of household, $21,900. There are also slightly higher standard deduction amounts for individuals who are age 65 or older, or who are blind. Thanks to tax law changes in recent years that nearly doubled these amounts, about 90% of households now take the standard deduction. It's simple, it's straightforward, and for many, it provides a larger deduction than they could get by itemizing. Itemizing deductions, the detailed path. So if the standard deduction is so simple, why would anyone choose a different path? The answer is, because for some people, the detailed path can lead to a much bigger deduction. Itemizing means you don't take the fixed standard deduction amount. Instead, you add up all of your individual, eligible expenses throughout the year. If the grand total of these expenses is greater than your standard deduction amount, then it makes financial sense to itemize. These deductions are calculated and reported on a form called Schedule A, Itemized Deductions, which you attach to your Form 1040. What kind of expenses can you itemize? Here are some of the most common categories. State and local taxes. SALT. This includes state and local income taxes or sales taxes. You have to choose one, as well as property taxes. However, the total SALT deduction is currently capped at $10,000 per household per year, $5,000 for married couples filing separately. Home mortgage interest. If you are a homeowner, you can often deduct the interest you pay on your mortgage for your primary residence and a second home. There are limits based on the mortgage amount. Charitable contributions. Donations of cash or property made to qualified charitable organizations can be deducted. You need to have records like bank statements or receipts from the charity to back up your contributions. Medical and dental expenses. This is a significant one, but it has a high threshold. You can only deduct the amount of your out-of-pocket medical and dental expenses that exceeds 7.5% of your adjusted gross income, AGI. This can include things like doctor's fees, prescription costs, and insurance premiums you paid with after-tax money. Making the choice, a simple comparison. The decision of whether to itemize really comes down to a simple math problem. Step 1. Add up all your potential itemized deductions for the year. Get a total for your state and local taxes, up to the $10,000 cap, your mortgage interest, your charitable giving, and any qualifying medical expenses. Step 2. Find the standard deduction amount for your filing status for that year. Step 3. Compare your total from Step 1 with the amount from Step 2. If your total itemized deductions are greater than your standard deduction, you will likely benefit from itemizing. If your standard deduction is greater than your total itemized deductions, you will likely benefit from taking the standard deduction. Let's look at a quick example. Imagine a married couple filing jointly. Their standard deduction for 2024 is $29,200. Throughout the year, they had the following expenses. State and local property and income taxes, $12,000, but capped at $10,000. Mortgage interest paid, $8,000. Charitable contributions, $2,000. Their total itemized deductions would be $10,000 plus $8,000 plus $2,000 equals $20,000. In this case, their standard deduction of $29,200 is much higher than their total itemized deductions of $20,000. They would be better off taking the standard deduction, as it would lower their taxable income by an additional $9,200. However, if that same couple had a very large mortgage and paid $20,000 in interest, their total itemized deductions would be $10,000 plus $20,000 plus $2,000 equals $32,000. Since $32,000 is greater than the $29,200 standard deduction, they would save money by itemizing. Most tax software will automatically do this comparison for you, but it's helpful to understand the logic behind it, so you can gather the right documents. That concludes our look at the standard deduction versus itemizing. It's a fundamental choice, but one that becomes clear once you know your numbers. In our next chapter, we'll address a question that's become increasingly common in the modern economy. How do I file taxes if I'm self-employed? This is a crucial topic for freelancers, gig workers, and small business owners. Thank you for listening, and I'll see you in the next chapter. Hello and welcome back to Top 10 Most Googled Tax Questions in the US Answered. In the modern economy, more and more people are embracing the freedom and flexibility of self-employment. Whether you're a freelancer, a gig worker, a consultant, or a small business owner, being your own boss is an incredibly rewarding path. However, it also means you have a new role to play. You are now responsible for your own taxes in a way that traditional employees are not. This leads to one of the most urgent and common questions we see online. How do I file taxes if I'm self-employed? The shift from receiving a W-2 to handling 1099s and estimated taxes can feel daunting at first. Suddenly, you're responsible for things your old employer used to handle behind the scenes. But there's no need to be intimidated. In this chapter, we will walk you through the fundamental concepts of self-employment tax. We'll cover what it is, the importance of quarterly estimated taxes, and the mindset you need to adopt for good record keeping. This will be a foundational guide for anyone just starting their entrepreneurial journey, designed to replace confusion with confidence. Important disclaimer: educational information, not professional advice. Before we unpack these new responsibilities, we must begin with our essential disclaimer. The information provided in this chapter is for educational and informational purposes only. It is not, and should not be considered, professional tax, financial, or legal advice. We are not licensed tax professionals. The tax obligations of a self-employed individual can be complex and are highly dependent on your specific industry, income, and business structure. For personalized guidance, it is crucial that you consult with a qualified professional, such as a certified public accountant (CPA), who can help you navigate your unique tax situation. The big shift: from employee to business owner. When you work for a traditional employer, they withhold taxes from each paycheck. This includes federal and state income tax, as well as FICA taxes, which cover your contributions to Social Security and Medicare. Your employer pays half of the FICA taxes, and you pay the other half. When you become self-employed, the IRS views you as a business owner. This means you are now responsible for paying the entire amount of Social Security and Medicare taxes yourself. This is what's known as the self-employment tax. The self-employment tax rate is 15.3% of your net earnings from self-employment. This breaks down into 12.4% for Social Security up to an annual income limit, which changes yearly. 2.9% for Medicare with no income limit. This 15.3% is in addition to your regular federal income tax. This is a critical point to understand, and is the main reason why proactive tax planning is so important for the self-employed. The good news is that you do get to deduct 1/2 of your self-employment tax when calculating your adjusted gross income, AGI, which is a helpful benefit. The end of the paycheck withholding, estimated taxes. Because you no longer have an employer withholding taxes for you. You can't just wait until the April tax deadline to pay your entire tax bill for the year. Instead, the US has a pay-as-you-go system. For the self-employed, this means you are generally required to pay your income tax and self-employment tax throughout the year in 4 quarterly installments. These are called estimated tax payments. Think of it as paying your taxes in advance. You have to estimate how much income you will earn for the year, and then calculate the tax you'll owe on that income. You then divide that amount by 4 and send a payment to the IRS by the quarterly due dates. The due dates for estimated taxes are typically April 15th, for income earned from January 1st to March 31st. June 15th, for income earned from April 1st to May 31st. September 15th, for income earned from June 1st to August 31st. January 15th of the next year, for income earned from September 1st to December 31st. Failing to pay enough tax through these quarterly payments can result in an underpayment penalty when you file your annual return. This is why it's so important to get into the habit of setting aside money from every payment you receive. A common rule of thumb is to set aside 25 to 30% of your gross income for taxes, though the exact amount will depend on your income level, deductions, and location. Keeping track, the importance of good records. As a business owner, you are now able to deduct the ordinary and necessary expenses of running your business. These business deductions lower your net earnings from self-employment, which in turn lowers both your income tax and your self-employment tax. This is a huge advantage, but it comes with a responsibility. You must keep excellent records. To claim these deductions, you need proof of your expenses. This means keeping all your receipts, invoices, and bank statements organized. Some common categories of business expenses for freelancers and sole proprietors include home office deduction. If you have a dedicated space in your home that you use exclusively and regularly for your business, you may be able to deduct a portion of your home expenses. Office supplies, paper, pens, software subscriptions, and other supplies needed to run your business. Business travel, costs for transportation and lodging for business-related trips. Professional development, the cost of courses, workshops, or industry publications that improve your skills in your field. Health insurance premiums. Self-employed individuals may be able to deduct the premiums they pay for medical, dental, and long-term care insurance. Keeping your business finances separate from your personal finances by having a dedicated business bank account is one of the best first steps you can take. It makes tracking your income and expenses significantly easier come tax time. You'll report your self-employment income and expenses on a form called Schedule C, Profit or Loss from Business, which is filed with your personal Form 1040. Stepping into self-employment is a major achievement. By understanding these core tax responsibilities from the start, you can build a strong foundation for your business and avoid surprises down the road. That concludes our introduction to self-employment taxes. In our next chapter, we will venture into a very modern and often confusing topic. What are the tax implications of cryptocurrency? Thank you for listening, and I'll see you in the next chapter. Hello and welcome back to Top 10 Most Googled Tax Questions in the US Answered. We're now moving from the well-established paths of self-employment tax into a territory that is new, evolving, and a significant source of confusion for many: cryptocurrency. With the rise of digital assets like Bitcoin, Ethereum, and thousands of others, a pressing question has emerged. What are the tax implications of cryptocurrency? Many people who dip their toes into the crypto world are unaware that their activities can have very real tax consequences. It's not like foreign currency, and it's certainly not invisible to the tax authorities. The IRS has made it clear that it is taking digital assets seriously, and there's even a question about them right at the top of the main tax form, Form 1040. In this chapter, we will demystify the basics of how the US government views and taxes cryptocurrency. We will focus on the fundamental principles you need to be aware of, explaining what a taxable event is and the importance of record keeping, all in a clear and easy to understand way. Important disclaimer: this is a complex and evolving area. Before we proceed, it is more critical than ever to emphasize our standard disclaimer. The information in this chapter is for educational and informational purposes only. It is not tax, financial, investment, or legal advice. Cryptocurrency tax law is a new and highly complex field that is still developing. The rules can be nuanced and may change. For advice on your specific transactions and holdings, it is absolutely essential that you consult with a qualified tax professional who specializes in digital assets. The core principle: crypto is property. To understand how cryptocurrency is taxed, you must first understand how the IRS classifies it. The IRS does not view cryptocurrency as a currency, like the US dollar or the euro. Instead, for federal tax purposes, the IRS treats virtual currency as property. This is the single most important concept to grasp. Because crypto is treated as property, it means the same general tax principles that apply to transactions involving other forms of property, like stocks, bonds, or real estate, also apply to crypto. This leads us directly to the concept of capital gains and losses. What is a taxable event? A taxable event is any transaction that triggers a tax consequence. When you simply buy cryptocurrency with US dollars and then hold it, that is not a taxable event. The tax implications arise when you dispose of your cryptocurrency. Here are the most common taxable events. Selling crypto for cash. If you sell your Bitcoin for US dollars, this is a taxable event. Trading one crypto for another. If you trade your Ethereum for another cryptocurrency, like Cardano, this is a taxable event. The IRS views this as selling your Ethereum and immediately buying the other coin. Using crypto to buy goods or services. If you use your crypto to buy a cup of coffee, a new computer, or even a car, this is a taxable event. You are technically selling your crypto for the fair market value of the item you are buying. In each of these scenarios, you have disposed of your property, the crypto, and you need to calculate whether you have a capital gain or a capital loss. Calculating capital gains and losses. When you have a taxable event, you calculate your gain or loss using a simple formula. Fair market value proceeds. Cost basis equals capital gain or loss. Fair market value is what you received in return for your crypto. If you sold it, it's the amount of cash you got. If you traded it or used it for a purchase, it's the US dollar value of the crypto at the time of the transaction. Cost basis is what you originally paid for the crypto, including any fees. Let's use a simple example. Say you bought 1 unit of a cryptocurrency for $1,000. That's your cost basis. A year and a half later, you sell that 1 unit for $1,500. $1,500 proceeds. $1,000 cost basis equals $500 capital gain. You would then need to report this $500 gain on your tax return. The amount of time you held the asset before selling it is also crucial. Short-term capital gain. If you held the crypto for 1 year or less before selling, it's a short-term gain. These gains are typically taxed at the same rates as your ordinary income. Long-term capital gain. If you held the crypto for more than 1 year, it's a long-term gain. These gains are taxed at different, and often more favorable, rates. If you sell your crypto for less than you paid for it, you have a capital loss, which can sometimes be used to offset capital gains and a limited amount of your ordinary income. Record keeping is not optional. Because every trade and every purchase with crypto is a taxable event, keeping meticulous records is absolutely essential. For every single transaction, you need to know the
Disclaimer. This video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.
date you acquired the crypto, your cost basis, how much you paid in US dollars, the date you sold, traded, or used the crypto, the fair market value in US dollars at the time of the transaction. This can become incredibly complicated very quickly, which is why many people who are active in crypto use specialized software to track their transactions. There are also other ways to acquire and use crypto, such as through mining, staking rewards, or receiving airdrops. The tax treatment for these can be even more complex, often being treated as ordinary income when received. Again, this highlights the need for professional guidance that covers the fundamental principles of cryptocurrency taxation. The key takeaway is that crypto is property, and you must track your transactions to report your capital gains and losses. In our next chapter, we'll return to a more traditional area of personal finance as we answer the question, can I deduct student loan interest? Thank you for tuning in, and I look forward to guiding you through our next topic. Hello and a warm welcome back to Top 10 Most Googled Tax Questions in the US, Answered. For millions of Americans, student loans are a fundamental part of their financial lives. The cost of higher education means that borrowing money is often a necessity to achieve academic and career goals. While repaying these loans is a long-term commitment, the tax code offers a small but helpful provision to ease that burden. This leads us to a very common and important question. Can I deduct student loan interest? The short answer is yes, many people can. This is a valuable tax benefit because it is an above-the-line deduction. This means you don't have to itemize your deductions to claim it. You can take this deduction in addition to the standard deduction, and it works by directly reducing your adjusted gross income, AGI, which can lower your overall tax bill. However, as with most tax benefits, there are specific rules and limitations you must meet to qualify. In this chapter, we will walk through the eligibility requirements, the deduction limits, and what you need to know to see if this benefit applies to you. Important disclaimer: a guide, not a guardian. As always, before we get into the specifics, we must begin with our essential disclaimer. The information provided in this audio series is for educational and informational purposes only, and should not be considered professional tax, financial, or legal advice. We are not licensed financial professionals. The rules for tax deductions can be complex and are subject to change. Your eligibility depends entirely on your specific circumstances. We strongly urge you to consult with a qualified professional, such as a certified public accountant (CPA), for guidance tailored to your individual tax situation. The basics of the deduction. The student loan interest deduction allows you to deduct the lesser of two amounts: either the actual amount of interest you paid on qualified student loans during the year, or $2,500. So if you paid $1,500 in interest, you could potentially deduct $1,500. If you paid $3,000 in interest, your deduction would be capped at the maximum of $2,500. You'll typically receive a form called 1098-E, Student Loan Interest Statement, from your loan servicer if you paid $600 or more in interest during the year. This form will show you the exact amount of interest you paid, which you'll need when you file your tax return. Even if you paid less than $600 and don't receive a form, you are still entitled to deduct the interest you paid. You can find the amount on your servicer's website or by contacting them. Who is eligible to claim the deduction? To claim the student loan interest deduction, you must meet a specific set of criteria. Here are the key requirements. You paid interest on a qualified student loan. This seems obvious, but it's the first step. You are legally obligated to pay the loan. The loan must be in your name. If a parent or someone else makes a payment on your behalf on a loan for which you are legally responsible, the IRS treats it as if they gave you the money, and you then paid the interest. Therefore, you are the one who can claim the deduction. Parents can only claim the deduction if the loan is in their name, such as a federal Parent Plus loan. Your filing status is not married, filing separately. You can claim the deduction if your status is single, married filing jointly, head of household, or qualifying widow, but not if you are married and file separate returns. Neither you nor your spouse, if filing jointly, can be claimed as a dependent on someone else's return. If your parents can still claim you as a dependent, you cannot take the deduction, even if you are the one paying back the loan. The income limitation, a major factor. This is the rule that often disqualifies higher earners from taking the deduction. Your ability to claim the full deduction is based on your modified adjusted gross income, MAGI. The IRS sets income thresholds each year that are adjusted for inflation. For the 2024 tax year, the income phase-out ranges are: for single, head of household or qualifying widow or filers, the deduction begins to be phased out if your MAGI is between $80,000 and $95,000. For those who are married filing jointly, the phase-out range is between $165,000 and $195,000. What does phase-out mean? It means that if your income falls within that range, you can only take a partial deduction. If your income is below the range, you can take the full deduction you qualify for. If your income is above the top end of the range, you cannot take the deduction at all. Tax software will handle the phase-out calculation for you. But it's important to be aware that these limits exist. What is a qualified student loan? The deduction only applies to loans taken out solely to pay for qualified education expenses. A qualified student loan is one you took out for yourself, your spouse, or someone who was your dependent at the time you took out the loan. The money must have been used for qualified education expenses at an eligible educational institution. These expenses include tuition and fees, room and board, with certain limitations, books, supplies, and equipment, other necessary expenses like transportation. This can include both federal and private student loans. What doesn't qualify? A loan from a relative or a loan from a qualified employer plan would not be eligible. The student must have been enrolled at least half-time in a program leading to a degree, certificate, or other recognized credential. Understanding the rules for the student loan interest deduction can help you make sure you're not leaving any money on the table. It's a small but meaningful way the tax system acknowledges the significant investment you've made in education. That wraps up our discussion on deducting student loan interest. In our final chapter of this series, we will address a question that causes a great deal of anxiety. What happens if I don't file my taxes? Thank you for listening, and I'll see you in our concluding chapter. Hello and welcome back. We've successfully answered the top 10 most Googled tax questions, and now we're moving into a few bonus chapters to tackle some equally important topics. There are few things that can make your heart skip a beat quite like seeing an official-looking envelope from the Internal Revenue Service in your mailbox. For many, the immediate reaction is panic, with visions of audits and serious trouble. But the reality is that most notices from the IRS are far more routine than you might think. This leads to a crucial question that wasn't on our top 10 list, but is on the minds of millions every year. What do I do if I get a notice from the IRS? In this chapter, we're going to demystify that experience. Our goal is to take the fear out of the equation and replace it with a clear, calm, and practical set of steps. We will cover why the IRS sends notices, what you should do when you receive one, and how to respond effectively. You'll learn that handling an IRS notice is usually a straightforward process that you can manage with confidence. Important disclaimer: informational guide, not legal counsel. Before we outline these steps, it is absolutely critical to state our disclaimer. This chapter provides general information and is for educational purposes only. It is not a substitute for professional legal or tax advice. Every IRS notice is unique to the taxpayer's specific situation. If you receive a notice that you do not understand, that involves a significant amount of money, or that alleges serious issues, you should immediately consult with a qualified tax professional, such as a certified public accountant, CPA, an enrolled agent, or a tax attorney who can represent you. First and foremost, don't panic. Let's start with the most important rule. Do not panic, and do not ignore the notice. The vast majority of IRS letters are not about a full-blown audit. The IRS sends out millions of automated notices each year for a wide variety of reasons. Common reasons include: you have a balance due. Perhaps there was a small miscalculation on your return. Your refund amount has been adjusted. Maybe they corrected an error, and you are due a slightly larger or smaller refund. They have a question about your return. This is often a simple request for more information or clarification. They need to verify your identity. This is a security measure to protect you from fraud. There is a discrepancy in reported income. A very common notice, often called a CP-2000, is generated when the income reported by your employer or a financial institution on a W-2 or 1099 doesn't match the income you reported on your return. Most of these are simple, computer-generated issues that can be resolved easily. Ignoring the letter is the one thing that is guaranteed to make the situation worse, as it can lead to additional penalties, interest, and more aggressive collection actions. A step-by-step guide to responding. Once you've taken a deep breath, here is a practical, step-by-step process for handling the notice. Step 1. Read the entire notice carefully. Every IRS notice has a number in the top right-hand corner, e.g. CP 2000, CP 14. This number identifies the specific issue. The notice will explain why the IRS is contacting you, what tax year it pertains to, and what they are proposing to do. Read every page to make sure you understand the situation, and most importantly, the deadline for your response. Step 2. Compare the notice with your tax return. Get your copy of the tax return for the year mentioned in the notice. Go through the IRS's proposed changes line by line, and compare them to your original filing. Was there a simple math error? Did you forget to report a small amount of interest income from a savings account? Often, you will be able to see exactly what the discrepancy is. Step 3. Decide if you agree or disagree. Based on your review, you will fall into one of two camps. If you agree with the notice, the process is usually very simple. The notice will include a response form. You'll check the box indicating you agree, sign it, and send it back. If you owe money, you should pay the amount due by the deadline to minimize interest and penalties. The notice will include instructions on how to pay. If you can't pay the full amount, there are options like setting up a payment plan with the IRS. If you disagree with the notice, you still need to respond by the deadline to protect your rights. Your response should be a formal letter explaining why you disagree with the proposed changes. Be clear, professional, and stick to the facts. State the specific parts of the notice you believe are incorrect and provide a clear explanation for your position. It is crucial to include copies of any supporting documents, such as corrected 1099s, bank statements, or receipts, that prove your case. Do not send original documents. Step 4. Respond in writing by the deadline. Whether you agree or disagree, mail your response to the address provided in the notice. It is highly recommended that you send your response via certified mail, with a return receipt requested. This provides you with legal proof that the IRS received your correspondence and on what date. Keep a copy of everything you send to the IRS for your records. When to call a professional. While you can handle many simple notices on your own, it is wise to seek professional help if you don't understand the notice or what the IRS is asking for. The notice involves a large or complex financial discrepancy. You disagree with the IRS, but are unsure how to build your case. The notice is about an audit or a repeat issue from a previous year. A tax professional can help you understand the situation, communicate with the IRS on your behalf, and ensure the issue is resolved properly. That concludes our guide to handling an IRS notice. Remember, stay calm, be methodical, and respond in a timely manner. In our next chapter, we will shift from dealing with tax problems to proactive tax planning. We'll answer the question: what are the basic tax advantages of retirement accounts like 401k, and IRAs? Thank you for listening, and I'll see you in the next chapter. Hello and welcome back to our bonus chapters of Top 10 Most Googled Tax Questions in the US, Answered. In our last chapter, we looked at how to react when the IRS contacts you. Now we're making a deliberate shift from a reactive mindset to a proactive one. We're going to talk about one of the most powerful tools available to taxpayers for managing their long-term financial health: the retirement savings account. When you hear terms like 401k or IRA, you might think they are just about saving for the future. And while that is their primary purpose, they are also incredibly powerful tax planning tools. The US government wants to encourage citizens to save for their own retirement, and it does so by offering significant tax advantages through these accounts. Understanding these benefits can not only help you build a more secure future, but can also positively impact your tax situation today. In this chapter, we will provide a foundational overview of the tax benefits of the most common retirement accounts, explaining how they work without getting into specific investment advice. Important disclaimer: this is not investment advice. Before we explore these concepts, we must state our most critical disclaimer for this topic. The information provided here is for educational and informational purposes only. It is not financial, investment, or tax advice. The decision of where and how to save for retirement is deeply personal and depends on many factors, including your age, income, risk tolerance, and financial goals. For personalized retirement planning and investment advice, it is essential that you consult with a qualified and licensed financial advisor or a tax professional. The two main flavors, traditional versus Roth. Most retirement accounts, whether they are an employer-sponsored 401k or an individual retirement arrangement, IRA, that you open yourself, come in two main flavors: traditional and Roth. The difference between them comes down to one simple question. Do you want your tax break now, or do you want it later? 1. The traditional account, tax break now. When you contribute to a traditional 401k or a traditional IRA, you often get an immediate tax benefit. Pre-tax contributions. Your contributions are typically made with pre-tax dollars. This means the amount you contribute is deducted from your income for the current year, which lowers your taxable income. For example, if you earn $60,000 and contribute $5,000 to a traditional 401k, you will generally only pay income tax on $55,000 for that year. Tax-deferred growth. This is the second major benefit. Once your money is in the account, any earnings from your investments, whether from stocks, bonds, or other assets, grow year after year without you having to pay any taxes on that growth. This allows your money to compound more rapidly than it would in a regular, taxable brokerage account. Taxes in retirement. The pay later part of the deal comes when you retire. When you begin to withdraw money from your traditional account in retirement, generally after age 59 and a half, those withdrawals are treated as ordinary income and are taxed at your then current income tax rate. 2. The Roth account, tax break later. The Roth version flips the traditional model on its head. After-tax contributions. When you contribute to a Roth 401k or a Roth IRA, you use money that you have already paid taxes on. There is no upfront tax deduction in the year you contribute. Using our earlier example, if you earn $60,000 and contribute $5,000 to a Roth account, you still pay income tax on the full $60,000. Tax-free growth. Just like the traditional account, your investments within a Roth account grow completely tax-free. Tax-free withdrawals. Here is the powerful payoff. When you take qualified withdrawals from your Roth account in retirement, that money, both your original contributions and all the investment earnings, is completely tax-free. This can be an enormous benefit, especially if you expect to be in a higher tax bracket in the future. 401k versus IRA. A quick look. A 401k, or its nonprofit equivalent, a 403b, is a retirement plan sponsored by an employer. A major advantage is that many employers offer a match, where they contribute money to your account on your behalf. This is a key part of your compensation, and is a benefit you should understand. An IRA is an individual retirement arrangement that you open and manage on your own through a brokerage or financial institution. Almost anyone with earned income can open an IRA, giving you more control over your investment choices. It's important to know that both types of accounts have annual contribution limits that are set by the IRS and can change from year to year. There are also income limitations that may affect your ability to contribute to a Roth IRA or deduct contributions to a traditional IRA. Saving for retirement is a marathon, not a sprint. By understanding the tax advantages offered by these accounts, you can make more informed decisions about your long-term financial strategy. The choice between traditional and Roth is a strategic one, and understanding the mechanics is the first step. That concludes our overview of retirement account tax advantages. In our next chapter, we will explore another practical topic for many Americans: key tax considerations for homeowners. Thank you for listening, and I look forward to guiding you through our next subject. Hello and welcome back to our bonus chapters of Top 10 Most Googled Tax Questions in the US Answered. For many people, owning a home is a cornerstone of the American dream. It's a place to build a life, create memories, and establish roots. It is also, for most, the single largest financial asset they will ever own. Given this, it's no surprise that homeowners often have questions about how this significant part of their life intersects with their taxes. While the tax code has evolved over the years, there are still several key provisions that can make homeownership financially advantageous. Understanding these benefits can help you get a clearer picture of your overall financial situation. In this chapter, we will provide a high-level overview of some of the most important tax considerations for homeowners. We will touch on the deductions available while you own your home, and the major tax benefit you might receive when you decide to sell it. Our goal is to provide clear foundational knowledge on this very important topic. Important disclaimer: not real estate or tax advice. Before we explore the details, we must begin with our standard, crucial disclaimer. The information provided in this chapter is for educational and informational purposes only. It is not financial, real estate, or tax advice. The tax implications of owning and selling a home are complex and depend on a multitude of factors, including your location, your income, and the specifics of your property. For personalized advice, it is essential that you consult with a qualified team of professionals, including a certified public accountant, CPA, and a real estate professional. Deductions during homeownership. While you are living in and paying for your home, there are two primary deductions that you may be able to take if you choose to itemize your deductions. As we discussed in a previous chapter, you would only do this if your total itemized deductions exceed your standard deduction. 1. The mortgage interest deduction. This is perhaps the most well-known tax benefit of homeownership. In general, you can deduct the interest you pay on the mortgage for your primary residence and a second home. However, there are important limitations. Under current tax law, this deduction is limited to the interest paid on up to $750,000 of mortgage debt for married couples filing jointly, and $375,000 for a married taxpayer filing a separate return. This debt must have been used to buy, build, or substantially improve your home. If you took out your mortgage before December 16, 2017, you might fall under the older, more generous rules, which allowed for a deduction on up to $1 million of mortgage debt. You will receive a form from your lender, Form 1098, Mortgage Interest Statement, which shows the amount of interest you paid for the year. 2. The property tax deduction. The property taxes you pay to your state and local governments are also potentially deductible. These taxes are typically assessed based on the value of your home, and are used to fund public services like schools, police, and fire departments. However, the property tax deduction is part of the state and local tax SALT deduction. As we've mentioned before, the SALT deduction is currently capped at $10,000 per household per year, $5,000 for married couples filing separately. This cap includes your property taxes plus either your state and local income taxes or sales taxes. For homeowners in high-tax states, this cap is often reached very quickly. Because of the high standard deduction amounts and the $10,000 SALT cap, fewer people are able to benefit from these deductions than in the past, but for those who can, they remain valuable. The biggest benefit: selling your home. Perhaps the most significant tax benefit of homeownership comes when you sell your primary residence. The tax code includes a provision that allows many homeowners to exclude a large amount of the profit, or capital gain, from the sale from their income. This is known as the home sale gain exclusion. Here's how it works. If you meet the eligibility requirements, you can exclude up to $250,000 of the gain from the sale, if you are a single filer, $500,000 of the gain from the sale, if you are married and filing a joint return. To qualify for this exclusion, you must meet two key tests. The ownership test. You must have owned the home for at least 2 of the 5 years leading up to the date of the sale. The use test. You must have lived in the home as your primary residence for at least 2 of the 5 years leading up to the date of the sale. The 2 years do not have to be continuous. This is an incredibly powerful tax benefit. For example, if a married couple bought a home for $400,000 and sold it years later for $800,000, they would have a gain of $400,000. Assuming they meet the ownership and use tests, they could exclude that entire $400,000 profit from their income, meaning they would pay zero capital gains tax on it. This exclusion can generally be used each time you sell a primary residence, but not more than once every 2 years. Understanding the tax landscape of homeownership is a key part of making informed financial decisions. From the deductions you might take each year to the major exclusion you could receive upon selling, these rules play a significant role in the financial life of a homeowner. That concludes our overview of key tax considerations for homeowners. In our next chapter, we will discuss another common question. How long should I keep my tax records? Thank you for joining me, and I look forward to our next discussion. Hello and welcome back to the bonus chapters of Top 10 Most Googled Tax Questions in the US Answered. We've covered a lot of ground, from filing your return to understanding complex topics like cryptocurrency and homeowner benefits. Now we're going to address a question that deals with the aftermath of filing. How long should I keep my tax records? After you've filed your return, it's tempting to want to shred all that paperwork and clear out the clutter. But hitting send on your e-file or mailing your return isn't the end of the story. Keeping your tax records for the appropriate amount of time is a critical part of being a responsible taxpayer. These records are your proof. They substantiate the income, deductions, and credits you claimed on your return. But for how long do you need to keep them? Is it 3 years? 7 years? Forever? The answer can vary depending on your specific situation. In this chapter, we will provide a clear and simple guide to the IRS's general rules on record retention, so you can manage your paperwork with confidence and peace of mind. Important disclaimer: general guidance, not legal advice. As we dive into record-keeping rules, it's essential to start with our standard disclaimer. The information in this chapter provides general guidance from the IRS and is for educational purposes only. It is not legal or tax advice. The specific time frame for keeping your records can be affected by various factors, including state laws or your particular business or personal circumstances. For advice on your specific situation, we recommend consulting with a qualified tax professional or a legal expert. The general rule, the 3-year guideline. For the vast majority of taxpayers in most situations, the key number to remember is 3 years. The IRS recommends that you keep your tax records for 3 years from the date you filed your original return, or the due date of the return, whichever is later. This 3-year time frame is known as the period of limitations. It's the period during which you can amend your return to claim a credit or refund. And it's also the period during which the IRS can typically assess additional tax if it finds an error on your return. Let's clarify with an example. Suppose you filed your 2024 tax return on March 15, 2025. The official due date for that return was April 15, 2025. Since the due date is later than your filing date, the 3-year clock starts on April 15, 2025. This means you should keep the records for your 2024 return until at least April 15, 2028. After that date, you can generally feel safe shredding them. What records does this include? It includes not just a copy of the tax return itself, but all supporting documents, such as your W-2s, 1099s, receipts for deductions, bank statements, and brokerage statements. Exceptions to the 3-year rule. While the 3-year rule covers most common scenarios, there are some important exceptions where the IRS requires you to hold on to your records for longer. The 6-year rule for substantial underreporting of income. You should keep your records for 6 years if you do not report income that you should have reported, and this income is more than 25% of the gross income shown on your return. This is a more serious situation, and the IRS gives itself a longer window to detect such a significant omission. The 7-year rule for worthless securities. If you claim a loss from a worthless security or a bad debt deduction, the IRS recommends you keep your records for 7 years. When you should keep records indefinitely. In a few specific situations, the recommendation is to keep your tax records permanently. You should keep records indefinitely if you file a fraudulent return. You do not file a return at all. In these cases, the period of limitations never expires, meaning the IRS can question or assess tax at any time in the future. What about records for property? There is another very important category of record keeping, and that relates to property you own, such as a home, stocks, or a business. You should keep records related to property for as long as you own it, plus 3 years after the year in which you sell or otherwise dispose of it. Why? These records help you determine your basis in the property. Your basis is typically what you paid for the asset. When you sell the property, your gain or loss is calculated by subtracting your basis from the sale price. Without records to prove your basis, you could end up paying far more in capital gains tax than necessary. For a home, this includes records of the original purchase price plus the cost of any significant improvements you made, such as adding a new room or remodeling a kitchen. For stocks or mutual funds, it includes statements showing what you paid for the shares. Organizing your records. Knowing how long to keep your records is the first step. The second is keeping them organized. Whether you prefer a physical filing cabinet with neatly labeled folders for each tax year, or a secure digital system where you scan and save your documents, the key is consistency. A well-organized system will save you a tremendous amount of stress if you ever need to reference your records in the future. That concludes our guide to tax record retention. For most people, the 3-year rule is all they need to remember, but knowing the exceptions provides a complete picture. In our final chapter, we will explore a topic relevant to the growing number of entrepreneurs and small business owners. A basic comparison of business structures for tax purposes. Thank you for listening, and I'll see you in our final chapter. Hello and welcome to the final chapter of our series, Top 10 Most Googled Tax Questions in the US Answered. We have traveled a long road together, from basic filing questions to proactive financial planning. To conclude our journey, we will address a topic that is foundational for every entrepreneur, freelancer, and small business owner. Understanding the basic tax implications of your business structure. Choosing how to structure your business is one of the first and most important decisions you will make. While there are many legal and liability factors to consider, the tax consequences are a huge piece of the puzzle. How your business is structured determines how you pay taxes on the money you earn. In this concluding chapter, we will provide a very high-level, educational comparison of 3 of the most common structures for small businesses: the sole proprietorship, the limited liability company, LLC, and the S corporation, S corporate. Our aim is not to recommend one over the other, but to give you a clearer understanding of how they differ from a tax perspective. Important disclaimer: this is not legal or business advice. As we embark on this final topic, our disclaimer is more important than ever. The information provided here is for educational purposes only, and is a simplified overview of complex topics. It is not legal, financial, or tax advice. Choosing a business structure has significant and lasting legal and tax consequences. Before making any decisions, it is absolutely essential that you consult with a qualified team of professionals, including a business attorney and a certified public accountant (CPA), who can provide advice based on your specific industry, goals, and financial situation. 1. The sole proprietorship, the default and simplest form. A sole proprietorship is the most common and simplest business structure. If you begin working for yourself and don't take any formal legal steps to register as another type of business, you are automatically considered a sole proprietor. Tax treatment. From a tax perspective, a sole proprietorship is not legally separate from its owner. This is known as a pass-through entity. There is no separate business tax return. Instead, all of your business's profits or losses pass through to you personally. How you file. You report all your business income and expenses on a form called Schedule C, Profit or Loss from Business, which you file along with your personal Form 1040. The net profit from your Schedule C is then subject to both your regular income tax and the self-employment taxes, for Social Security and Medicare, that we discussed in an earlier chapter. Simplicity is key. The main advantage here is simplicity. The bookkeeping is relatively straightforward, and you don't have the complexity of filing a separate business tax return. 2. The limited liability company, LLC. Flexibility and protection. An LLC is a formal business structure created by state statute. Its primary purpose is to provide the owner or owners, known as members, with limited liability protection, meaning their personal assets are generally protected from business debts and lawsuits. Tax treatment. The tax treatment of an LLC is incredibly flexible. By default, the IRS treats an LLC in the same way it treats a sole proprietorship if it has only one owner. This is called a disregarded entity. All the income and expenses pass through to the owner's personal tax return via Schedule C, exactly like a sole proprietorship. If the LLC has multiple owners, it is treated by default as a partnership, and the profits and losses are passed through to the owners to report on their personal returns. The power to choose. The key feature of an LLC is that it can elect to be treated differently for tax purposes. An LLC can choose to be taxed as an S corporation or even a C corporation, though that is less common for small businesses. This flexibility is a major reason why LLCs are so popular. 3. The S corporation, S corp. A different tax structure. An S corporation, or S corp, is not a business structure itself, but rather a special tax election made with the IRS. A business must first be structured as an LLC or a corporation, and then file a specific form to be treated as an S corp for tax purposes. Tax treatment. An S corp is also a pass-through entity, so the business itself does not pay federal income tax. The profits and losses are passed through to the owners. The key difference: reasonable salary and distributions. Here is the most significant difference. An owner who works in the business must be paid a reasonable salary as an employee. This salary is subject to regular payroll taxes, Social Security and Medicare, just like any employee's wages. Any remaining profits from the business can then be passed through to the owner as distributions. These distributions are generally not subject to self-employment or payroll taxes. This potential for tax savings on distributions is the primary reason why business owners consider the S corp election. Added complexity. This structure comes with more administrative burdens. You must run payroll, file payroll tax returns, and ensure the salary you pay yourself is considered reasonable by the IRS, which can be a complex determination. Conclusion of the series. And with that, we conclude our 15-chapter journey. From understanding your first tax deadline to exploring the blueprint of your business, we hope this series has served its purpose to take the fear and confusion out of the world of U.S. taxes and empower you with clear, accessible, and foundational knowledge. Taxes are a part of life, but they don't have to be a source of anxiety. With the right information and the guidance of qualified professionals, you can navigate your financial obligations with confidence and clarity. Thank you for joining us for this series. We wish you the very best on your financial journey.
Disclaimer: this video is for informational and educational purposes only and should not be considered professional legal, financial, or tax advice. I am not a certified public accountant, CPA, or a tax attorney. You should consult with a qualified professional for advice tailored to your individual situation. Tax laws are complex and subject to change. The creator of this video or the channel will not be held liable for any actions taken based on the information provided.